Hi everyone, welcome back to the channel. It's been a while since I made an update about Pershing Square Holdings. Pershing has been a co-position in my portfolio for some time now. It's an investment company that's trading at a discount to the net value of the assets that it controls, led by one of the most well-known value investors, Bill Ackman. But recently it's been in the news for all the wrong reasons. There are quite a few changes in the underlying fundamentals for Pershing Square, and that is what I wanted to go over today. Recently, Pershing published a press release mentioning their intention to change the existing dividend policy. They stated that the dividend would be determined by multiplying the PSH NAV by 0.25%, and there was a cap set based on the dividends paid out in previous years. Once the dividend was set for a specific year, they do not intend to decrease it from that level, even in the event that the NAV were to decline. This may have been an effort by the board to draw more attention to reduce the discrepancy between the NAV and the share price, since the share price has always traded at a discount to the PSH NAV. This may have also been an effort to make the company appear more attractive to investors focused on income rather than capital gains. The intent here is not explicitly stated. The only explanation that we get in the press release is that the increase in quarterly dividends is in line with the goal to maximize long-term CAGR, or the compounded annual growth rate. To me, buybacks would be a better use of capital than dividends. This is what I would have preferred to hear from the board, and that's exactly what the company announced earlier this month. In a new press release, the company announced a $100 million share buyback program. PSH has again been trading at a discount of 35% to NAV, and buybacks are a great way to return money to shareholders and hopefully reduce that discount. I hope that Ackman dives deeper to explain his reasoning for the change in the dividend policy and how he thinks that would increase the long-term performance of the fund. It's been difficult to gauge if Ackman's focus has changed with the change in strategy. Recently, the macro calls and hedges that Ackman has been employing have had a better result than the plain vanilla stock picking, where he talks about focusing on simple, predictable, free cash flow generative businesses. As mentioned in the recent investor presentation, they were able to get a 7.4x gain on hedges that would benefit as interest rates increased. The gain from this hedge position was used to purchase a sizable stake in Netflix, which, as we all know, was subsequently sold at a loss of $400 million. That is a lot of money to lose, but Ackman has had larger losses in the past and still managed to deliver satisfactory returns for his shareholders. Broadly assessing the areas of focus for Pershing, we've got Pershing Square Tontine Holdings, the hedges, and the general equity portfolio, along with some debt. Pershing Square Tontine Holdings, for those who aren't familiar with it, is the largest special purpose acquisition company ever set up, with $4 billion in cash to pursue a deal to bring a private company to the public markets. The SPAC had previously tried to set up a deal with Vivendi to acquire 10% of Universal Music Group. The transaction eventually failed, as the deal was blocked by regulatory authorities on grounds that it was violating the rules set for SPAC transactions. Pershing Square Holdings, which is the fund, eventually was able to swoop in and complete this transaction to avoid potential litigation that could be imposed on the SPAC founders in the event that they were unable to complete this transaction. By buying 10% of UMG, Pershing had effectively allocated a little bit more than 26% of their overall capital. When we look at the stock price of UMG today, it is lower than its IPO price. At this point, it's probably too large of a holding to do anything with it. But when it comes to PSTH, the time that was set for the SPAC, the deadline, is approaching soon on July 24th. So far, it's been a painful and a fruitless endeavor for Ackman and those invested with him through the fund or the SPAC. This might change in the next 2 months. For now, it seems like there's a whole lot of activity happening at Pershing Square, but most of it, unfortunately, is not translating into positive results for its shareholders. An instant way that Ackman could deliver value is by cutting fees entirely and being completely aligned with his shareholders. Or he could even switch to a Buffett partnership style fee structure, which would be considered a lot more fair than the current fee structure. Either way, I'm closely monitoring Pershing Square and keeping up with the changes that they put up on their website. If you are invested in Pershing Square, then let me know your thoughts about why you invested here and what do you think about Bill Ackman's recent actions. If you'd like to connect with me either on Twitter or on Instagram, the links to those will be in the description below. Thanks for watching the video and take care.